Let's start with where the rate environment is. Do you think that advisors and the market have reconciled themselves not only with higher rates, but the uncertainty of where rates might go?
I'm mixed in that view because I think there is still a lot of exposure to low duration and cash, which suggests they're still worried about the falls in fixed interest markets that we saw last year that were driven by rate rises. But as you talk to people, I think they are fairly comfortable with rates at or near peak, maybe one more rate rise here in Australia, a little bit more perhaps in Europe and in the US that probably have peaked, given that inflation is coming down sharply. So I think what they're doing versus what they say about rates is actually, there's a tension between those two views.
So how would you guide advisors who have, perhaps correctly, bunkered down in term deposit rates as those term deposits are rolling out? On the margin, where would you suggest they start to look for the best investments, let's say on the 3 to 5 year time horizon?
I think they need to, if you're very low duration, I think you should be neutralizing duration. I think the cushion that it provides for if we do go into recession and have an equity market fall is meaningful and significant. So if equities fell and central banks in time were forced to cut rates, and let's say they cut rates by 100 or so basis points, you're going to have 6 or 7% capital return plus your 4% yield. You're going to have 10, 11% return. And in that time, your term deposit rates and your cash rates will actually fall. And so you will get your cash return from your cash bank accounts and your TDs, but it'll be a falling rate, whereas you'll get a positive and a nice positive return offset any equity pullback. So to me, the cushion is actually more meaningful than what it was and is advisable to move towards longer duration. The debate about when, I think timing it is very, very difficult. And so you could slowly start to do it. But if you're an advice business that can't say we're going to increase by, move a little bit of assets from a low duration manager or some term deposits into a longer duration manager, and you can't do it piece by piece over the next 3 to 6 months, and I think you need to do it probably even shorter than that to get ahead of the curve, then deciding how much exposure you want to have to the duration and making that move in the sort of next 2 to 3, maybe 3 months is probably the time to do it.
And in terms of some of the high-yielding strategies that people did put into portfolios, be they in private credit or just generally high-yielding, would you encourage people to reflect on how much weight they have on those? Because obviously in the falling rate environment, the risks are presumably higher, given that's likely to be accompanied by weak economic growth, but also the floating rate nature of those is likely to make them less appealing.
Yeah, I think as we went up the risk curve generally through the markets in the advised world and even in the professional world, I think the movement up the risk curve as quantitative easing was prevalent across the world. I think now it's sensible to roll back down the risk curve with quantitative tightening and the tightening of interest rates. Clearly, the default rate has been very, very low. And with this sudden increase in interest rates, I would have thought that default rates normalise. They mightn't go particularly high, but if they normalise, then there will be some pressure on those high-yielding investment solutions. And so to me, becoming more traditional, becoming more sovereign bonds, more, I suppose, liquid, daily priced fixed interest markets across the spectrum to some degree, will probably put you in a little bit better position because they're probably less affected by increased default rates and a turn in the interest rate cycle.
Now, in your many years of looking at funds, fixed income in particular it's struggled to get a good sense about what history tells us because of the impact of the 2002-03, where the historical track record is going to look awful for quite some time. If you were to decide to follow your advice and go into longer duration bonds today, what kind of methodology or what kind of guidelines would you suggest an advisor use?
I think, there is maybe a place for those who are cost concerned and who concern themselves with the ability to pick a manager that can mitigate the risks that are there and or deliver outperformance. Then some passive is potentially advisable, but certainly look for managers that can talk to the risks of the day and that are mitigating those risks, that are looking at where in credit markets, where in sovereign bond markets there are risks and they dial down or have no exposure. And that way, even if that risk doesn't come to fruition, you're probably okay. But if the risk does come to fruition and the issues arise, high default rates in certain sectors or stresses in certain sovereign bonds because of the debt indebtedness, then I think you will be much better positioned than if you're with a manager who's less concerned of those and more index hugging. But the reality is, when you look back over a long time frame, the passive tends to outperform, but it doesn't mean they manage the risks as well. And so to me, that's where I like to focus. Even if you come out benchmark-like return in a bond fund or a diversified fixed interest fund with longer duration, doesn't mean you didn't get a benefit of the risks that they hedged through the period of time that you're invested.
And last question, we're Inside Networks running this Income and Defences Forum both in Melbourne and Sydney. So let's go back to an old age battleground, Sydney versus Melbourne, and is that anywhere reflected in investment markets?
I'm not sure about investment markets. I think there is the sporting phenomena. My preference, I live in Sydney, I've been here for 10 years. All my family and friends are in Melbourne. I am an AFL supporter. I don't watch rugby. So to me, I'm leaning towards Melbourne. I'm looking forward to the conference down in Melbourne where I can see some family and friends and I can enjoy the conference.
Sounds like a great diversified strategy. Thank you, Paul.
Terrific. Thank you.